Welcome to the Holistic Accountant Podcast. The aim of this podcast is to demonstrate that many issues that your accountant deals with are multifaceted. Therefore, a holistic accountant's job is really to not only help you improve your business, but also help you improve your personal financial position. Before we get started today, I'd like to ask two favours. Firstly, if you enjoy this podcast, please share it amongst friends or colleagues that you think will all equally get some value from it, and or leave a rating where you listen to this podcast. It would help us tremendously. Secondly, if there are any topics that you're interested in, please let us know. There's an email address in the show notes that you can just drop us a quick email and ask us to present on a particular topic. Okay, let's get started. Okay, so today Mina and I want to talk about holiday homes, particularly if you go and buy a holiday house and rent it out on Airbnb or whatever it might be, and the tax treatment and tax considerations.
Yeah, so it's an area that the ATO is actually targeting very heavily lately, and it's important that you keep all your records very clean and have actually sort of third-party documentation to support your claims for any sort of expense, or most importantly is having third-party information as to when the property was actually available for rent. Because what the ATO don't like to see is you using it for personal use when the property wasn't available for rent, or you possibly took it down so you could enjoy it for the weekend. And then trying to claim the expense for the full financial year.
Yeah, so when it comes to the words genuinely available for rent, some of the things that the ATO considers is, was it advertised or in a way that doesn't limit its marketability? So, of course, if all you're doing is just, emailing a couple of friends to say a house is vacant, that's not really going to satisfy it. But if it's on a Airbnb or Stays or whatever, one of those websites that advertises short let accommodation, and it's been up on that site for 365 days of the last financial year, then there should be no problems. The other considerations are the location and condition of the property. So, if it's really run down and you've done very little to attract people to rent that property, that could be an issue. Or if you've put some unreasonable or stringent conditions on renting it, and that would go to also making it too expensive. So, people might think, well, if we ask $20,000 a night, no one's going to rent it, and then we can use it during that period of time. Well, obviously that's not going to satisfy it. So it's really about, it's a question of like, how much will you use it genuinely, and then how much is it genuinely available for let. And we find our clients, depending on the type of property and their family situation, but it can work really well for some clients and not so well for others. So for some clients, they'll use the property during the week, particularly if they can work from home. Leaves the weekends free where they get most of their bookings, and it works really well for them. For other clients, where particularly if they've got younger kids, they want to use it during school holidays and Christmas period and so forth, which is kind of, if it's a beachside sort of property, it's going to be the most popular times, and therefore it doesn't really work so well for them.
The other consideration is, how is it actually owned? So we find that a lot of holiday homes are actually owned in self-managed superannuation funds, or SMSFs. And there's strong sort of stringent guidelines that you can't actually use a property that's in your super fund, whether that be a holiday home or another sort of residential property. So it's really important that you have really good records to outline if the property is owned in a self-managed super fund, that it is genuinely available for rent all year round.
Yeah, correct. And actually even ownership in respect to, even if it's outside of your self-managed super fund, thinking about ownership from a land tax perspective as well can be important. So a client recently, they've got a holiday home and obviously a place in Melbourne. And they split their time between those two properties. Obviously, from a land tax perspective, we can nominate one main residence only. So one of those properties we could nominate as a main residence. And we decided to nominate the holiday home because it had a much lower land value than their previous long-term home, and would save them about $10,000 a year in land tax. And so to do that, the client obviously had to call the SRO to make that change. change their electoral roll, license, and so forth to make sure that they can prove that's their predominant main residence. But thinking about those sorts of things. Another example: a client has property in the Northern Beaches in Sydney. They expect to generate quite a bit of income from it. They might use it quite a bit, but also they expect to generate quite a bit of income. It's likely then to be cash flow positive. That is, produce an ongoing income tax liability. And so we put the property in his wife's name. She earns a much lower income than he does. So even ownership around holiday homes, particularly if you are going, well, even if you aren't going to rent it out just from a land tax perspective, but if you are going to rent it out from an income tax perspective, something to really think about.
So if you are using it for personal use, you really, again, it comes down to record keeping, but you got to pro-rata all your annualised expenses. So things such as your insurance or your council rates or your water rates, your electricity bills, for example, you need to basically only claim the amount of the expense that relates to the actual period that you're leasing the property for. And this is what the ATO is really sort of honing in on, is that they're seeing that unfortunately there's a lot of people claiming the full annualised expenses despite the property only being available for rent for maybe only half the year. So it's something just to keep in mind also.
And if you rent the property to family or friends at kind of mates rates, so less than market value rates, that could also have a negative impact on what you can deduct. So, for example, if I didn't advertise my property but just rented it every now and again to some friends, and for $2,000, but the market rate would have been $10,000. Then the ATO is going to tell me I can only deduct up to $2,000 of legitimate deductions. That is, I can make my tax position neutral, but I can't claim a negative gearing benefit. I can't make it look like that I've made a loss just as a result of renting my property at below market value to friends. So there's a couple of things to look out for there. It really does come down to, really, as Mina said at the beginning, good record keeping, and then just interacting with your holistic accountant to make sure that you understand the rules and consequences of making certain decisions. And of course, if we do generate income from an asset, like a home, and we're not claiming that property as a main residence, of course, we're going to have an impact on our main residence exemption, so capital gains tax as well. So again, all these things need to be considered, and I think it's really just about making really informed decisions. All right, that's it for this week. Until next week, bye for now.